Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Brad Smith alongside Madison Mills this morning. Let's get to the three things that you need to know today.
First up, U.S. stock futures pushing higher this morning after closing sharply lower Monday amid President Trump's attacks on the Federal Reserve and continued policy uncertainty. Concern that the president could fire Federal Reserve Chair Powell, sparking a flight from treasuries and the U.S. dollar as investors pushed into havens like gold, which touched 3,500 for the first time ever.
The attention now turns to a slew of Fed officials speaking today. Investors will be watching for any commentary on the central bank's next move amid the rising political tensions with the White House. The flurry of appearances comes ahead of a quiet period for the central bank, with just 2 weeks until its next policy meeting, where traders are pricing in an 11% chance that the central bank will cut interest rates.
And all eyes turn to Tesla this afternoon. The EV maker will report earnings following one of the stock's worst ever quarters. Musk's political entanglements have pushed Tesla sales to a nearly 3-year low in the first 3 months of the year, leading a slew of Wall Street analysts to slash their growth expectations on the stock. The automaker's souring outlook and steep valuation has spooked investors, leading to a 53% plunge in Tesla's stock price since it hit a record back in December. You can tune in Tuesday evening on Yahoo Finance for full coverage of Tesla's first quarter earnings results.
U.S. stock futures moving to the upside this morning after a sharp sell-off on Monday amid lingering uncertainty from trade to President Trump's growing attacks on the Federal Reserve. Here to break down what this all means for the stock market is our own Josh Schaefer, and it's really all of it encapsulated as two major things that the markets are clearly latching onto, and most notably, it seems like from our guest yesterday, was just how much the Fed was, the president was focusing in on the Fed at the same time where there's still lingering uncertainty that we're hearing in earnings calls and from CEOs just about what tariff policy will look like.
Yeah, Brett, I mean, I think what you take sort of yesterday's discussion about President Trump potentially trying to fire Fed Chair Powell, it's just another pin in the bucket, right? Another issue that we can sort of add to the stock market story right now. I thought Stuart Kaiser from Citi put this well in his note after the trading day, saying that the path of least resistance is lower, and absent good tariff news, you have Fed headlines that just set the market in that direction kind of before the day started, right? Then you take today, for example, we didn't really have any negative headlines overnight, so there was nothing to really sort of set us in that direction. But I think largely what we learned yesterday and what rate strategists sort of took away from the action that we saw was if there is any concern about Chair Powell being removed from his seat, the trade is going to be the sell the U.S. trade we've been talking about, right? It's probably higher yields. It's probably a weaker dollar. And so now you know sort of what that trade looks like. And if this conversation continues, that's the kind of action you can expect. But I thought Ed Yardeni had a great point as he was sort of breaking down the different things at play. He said everyone's on edge, and then he added, I think, about 5 or 6 different things that are keeping us on edge, right? You have tariffs impact on earnings, you have tariffs impact on the economy and the recession concerns. Well, now let's throw in potentially the Fed chair getting fired, which basically never happens, into that. That's another thing that can keep us on edge, right? And so at this point, with the market where it's at, trading significantly lower than it has been over the past couple of years, right? We've had this big drawdown. You're in this choppy, bad market right now. Any incremental bad news, I think we have a good idea of where that's going to send stocks at this point.
And things aren't working the way they're supposed to. The traditional correlations between stocks, bonds, currencies are breaking down before our eyes. And one thing I wonder too, Josh, that we've talked a lot about is that stocks were already under a little bit of pressure prior to these tariffs and the so-called Liberation Day. How are your sources parsing out the moves to the downside we're seeing in the market right now in terms of what is policy uncertainty versus what is a continued unwind of some of those valuations?
Yeah, I think we're going to get an even closer look at that over the next 2 weeks, right, Maddie? So if you look at a stock like, say, Netflix. Netflix was one of the only stocks for most of the day. We had a little bit of rally at the end of the day, but it was one of the only stocks in the NASDAQ 100 that was up. Why was Netflix up yesterday? They had very good earnings on Thursday. The market was closed Friday, so that was its first trading session after earnings, right? That had been a stock that people loved. It was near an all-time high. before all of this tariff uncertainty. It came down with the market, but then bounced back up on fundamentals. So the question being, can that happen to some of these other stocks, right? You mentioned we were at a point in the market where, yes, tech was very overvalued. There was concerns about growing competition, candidly, in AI, right? And sort of competition from other countries, the spend there. So can those companies explain that story? Can Alphabet explain that story on Thursday and make that more clear for investors and bring that stock back a little bit? I think you're going to start to see perhaps individual moves and get back to a little bit of the fundamental story. But then again, zooming back out to the macro, most strategists right now are sort of telling me, you need this uncertainty to go away. If that's what started the drawdown, if the drawdown is spawned by policy uncertainty and spawned by tariffs, more clarity on tariffs is kind of the only thing that can bring you back from an index perspective.
I thought the candlesticks were very telling yesterday. And yeah, for everybody out there that just loves the line graphs and loves the mountain charts here, take a look at the candlesticks from yesterday, because I think that was very telling as well. You had a lot of down activity throughout much of the session, and it really wasn't until the last 45 minutes that you actually saw some buying start to overtake much of the sentiment. So it really kind of resumed the, all right, well, we've pulled back so much, even during this session, does it seem like there's some dip buying opportunities? And that's where at least a few of those bids seem to enter into the fray, but not a wave of it to really erase much of the decline.
No, you haven't seen a wave of buying really at all, Brad. It was interesting you point to that action yesterday. The move, it feels like, has generally been lower into the close over the past 2 weeks. So it was interesting to see us actually come off the lows for once. That has not really been the trend. But overall, yeah, I mean, it seems like the bias right now is still sell, ask questions later. There weren't a lot of buyers. There was a little bit of a low volume day in the market yesterday, right? It was a holiday for some folks, a little bit less busy. Our Julie Hyman was pointing that out. So you normally see some wider spreads and bigger moves. So it'll be interesting to see how we trade for the rest of the week as we all come back, and I'm sure there'll be more tariff.
I had to be the nerd to bring up the candlesticks here early on in the day.
We have no Jared Blickery this week. Someone's got to bring them up, Brad.
Sure, somebody's got to talk about these candlesticks.
Very true. Josh, thank you so much. Appreciate it. Well, the Sell America trade is taking hold amid concerns that President Trump could intervene in Federal Reserve leadership and policies. Stocks and the U.S. dollar recovering ground pre-market after plunging on Monday. Joining us now for more, Henrietta Treyz, Veda Partners Managing Partner and Director of Economic Policy. Henrietta, great to have you on here. I just want to get a sense of the conversations you've been having over the last 24 hours here plus. Are your clients asking you about whether or not the president can control the head of the Federal Reserve, or are they still focused on the broader tariff policy uncertainty?
You know, it's interesting. The Federal Reserve question has been an issue of conversation for me and my clients for almost a year and a half, 2 years before Trump was even elected president. This is something the street is inordinately focused on. There's obviously going to eventually be turnover starting in a couple months at the Fed. There's questions about who might be going, who's replacing him. Is it Scott Bessent? Is it Kevin Warsh? Who comes next? So that's definitely a very popular topic of conversation. And it's kind of a constant rebalancing of investors who are just trying to find some sort of foothold amongst the tariff uncertainty that is looking like it's going to be with us for months, if not years now.
If we did see Fed Chair Jay Powell ousted, and ultimately, let's remember, just the kind of baseline of this, he is in this role, or his term continues to move through mid-2026. If he was ousted, he has actually legal protections as well. So it would have to be for whatever miraculous cause gets kind of trumped up by the administration, pun fully intended. So all those things considered here, how does that also impact what the markets have become to and come to know for decades as the independence of the Fed? How does that throw that in jeopardy?
Well, the independence of the Fed is absolutely critical. I mean, I was a Senate staffer when we were taking votes on things like auditing the Fed, which a lot of folks don't even want. You need to have that independent Fed when there is so much power resting with one president who can change his mind at a day's or an hour's notice. That kind of uncertainty is, cataclysmic for markets. And that's what you've been seeing for the last couple of weeks. So what you really need is sort of a comfort level that this president will not upend norms and fire the Federal Reserve Chairman for, reasons that aren't exactly by the letter of the law, which is subject to interpretation. And right now, nobody has that confidence. Moreover, we don't have the leadership in the Republican conference on the House and the Senate side and it has to be Republicans because they're in the majority, and the minority members on the Democratic side don't have this power. You have to know that there's some sort of leash on the president, and there is not right now. And I would say, even now that we've got a new Senate Majority Leader in John Thune, and not the old hand of Mitch McConnell, is a little bit unsettling as well, because you don't know how far Senator Thune is willing to go to rein in the president on this. You can do things like stop nominations processes, stop forward progress on the reconciliation bill. There are things that the majority party in Congress can do to put a tether on the president, and they're not doing that right now. So that removes just another leash factor that we would otherwise see on any sitting president.
So Henrietta, if a client asks, is this something that could likely happen, what do you say?
I say I don't think so. I wouldn't expect it, but that's mostly because the market will send such a disastrous message. Now, I think the market has made that really clear, and I think that's positive and constructive. We did see the president react as the bond markets tanked a few weeks back during the tariff tumult. So there is some sort of leash, whether that's coming from Treasury Secretary Bessent, putting some sort of restriction on the president's impulses here. Right. So I'm optimistic that the market will send that message and has sent that message clearly. But the president is plainly jawboning about it, and that in and of itself is disruptive.
And you just said earlier that clients are just looking for solid ground here. Some members of the administration seem to think solid ground can come via tax cuts. Are they right?
That is their hope for sure. For example, when I speak with Republican leadership, chiefs of staff, and things along those lines, they'll tell me that just the certainty provided by passing a permanent extension of existing tax rates should be substantially stimulative because of the certainty that it provides to individuals. Now, when I say that to investors, they laugh, quite frankly, because you're effectively saying the tax rates that have been the same for the last 8 years are going to continue being the same, and they struggle to find that stimulative. But the idea of that certainty really speaks to just how much uncertainty there is elsewhere, that just in understanding the tax policy is going to remain static is good news. So they're really reaching here.
Henrietta, as I'm taking a look at the CME Fed Watch tool, as of right now, this morning, it seems like there's only ballpark around a 10%, 9.1% actually, now that I've refreshed my screen, chance that the Fed would actually cut at its May meeting. And a lot of the thinking coming into the start of this year is that with what they've already been monitoring in the economy and their own data dependency, they weren't expected to cut until the back half of this year. What is the likelihood that we see not just a cut in May, we know that that's 9.1% probability, but more cuts than anticipated as a response to what the Fed is trying to perhaps get ahead of in how much the tariffs could actually impact the economy?
The question, we talk about this a lot in investor meetings, if you're sitting in a room with 5 folks or 50 folks, this always comes up. And the main response is the Fed can't possibly cut right now. And I think that, I forget the number you said, 10.1% odds is pretty spot on with what I'm registering in client meetings. There is yet this additional conflict of Fed autonomy and the Federal Reserve stepping back and saying, we did not start this tariff war. This is a policy decision. This is up to the executive branch. We cannot be asked to engage, especially when inflation and unemployment are giving us the numbers that they're giving us right now. As this starts to seep in, obviously the Federal Reserve will react. I think that is something that is expected and back half year situation. But for right now, they can't be seen to be reactionary, particularly given the uncertainty around whether these tariffs are going to go into effect, not go into effect. How disruptive are they going to be? And all that's going to come out in earnings and over the next couple of weeks as we start to see bankruptcies from small businesses in particular, which would lead to layoffs, and then you get rate cuts. But I wouldn't expect them to be preemptive, especially with all this focus on potentially firing the Federal Reserve Chairman for no good reason.
Henrietta, thanks so much for taking the time here with us this morning.
Thanks for having me.
Coming up on Morning Brief, everyone, we count you down to the opening bell on Wall Street. Plus, we bring you the latest on the earnings front with movers from 3M to Verizon. And we'll break down what we can expect to hear from Fed officials with a full lineup ahead. We're Taking a look at some of today's trending tickers, we've got Novo Nordisk, Verizon, and 3M making some of the biggest moves this morning. First up, Novo Nordisk under pressure after rival Eli Lilly said last week its experimental weight loss pill helped diabetes patients lower blood sugar and lose weight. The positive results could threaten Novo Nordisk's market share for its popular injectable weight loss treatments Ozempic and Wegovy here. We also know that they've been working on some of the oral pills as well, which have notably moved through some of the different tests and clinical phases, and at this point, a positive result for an Eli Lilly oral weight loss drug has prompted BMO to really look across some of their own ratings. They downgraded Novo Nordisk with regard to the demonstrated statistically significant efficacy results and safety profile consistent with injectable GLP-1 medicines, they noted.
Yeah, and the reason that we're seeing these moves today as opposed to last week is because there was a bit of a vacation going on over in Europe. So this is the first trading day there after this news here. You can see those Novo shares actually recovering just a bit here off the back of some of that pressure. Also interesting to note, another analyst on the street saying that for Novo, this news has severe consequences. The idea that a lot of consumers might be attracted to a pill, both due to the fact that it's easier to consume and also potentially cheaper as well. Well, next up, Verizon reporting a larger than expected drop in subscribers during the first quarter, hit by strong competition. Still, the mobile network operator topping revenue expectations. The company also reaffirmed its annual adjusted profit and free cash flow outlook. The guidance does not reflect any potential impact from tariffs. Real quick, what I thought was fascinating here is this note about from Verizon that this was impacted by less government spending. Could that be DOGE related? That's a question that I have. And then just want to point out KeyBank commentary saying the stock is going to go down today and don't buy any weakness today, indicative that they don't see a recovery short term. Yeah,
they warned on softness on a few metrics. They noted specifically in the postpaid phone subscribers, that was a net loss of 289,000 in the first quarter. Losses in the consumer unit outweighing better performance that they had seen on the business side. And then additionally here, thinking about those postpaid subscribers and how those are essentially kind of summarized in summation, it's basically those paying at the end of the month versus the prepaid subscribers who are basically saying, oh, yeah, I got the money right now. You could just go ahead, take it, and I'll pay ahead of time for use of the service as well here. So really looking through the dynamic there, I think this is going to be interesting to see, especially for some of the core services. You think about your connectivity, that is one of the core services that consumers continue to pay for. And if we continue to see, or if we see rising in delinquencies, that would spell out a little bit more of a pressing situation for consumers.
Really good point.
Also here, thinking about 3M this morning. 3M maintaining its full year guidance, but acknowledging risks from the ongoing trade war. The maker of Scotch tape and Post-it notes saying tariffs could impact full year earnings by up to 40 cents per share. 3M is considered an economic bellwether because its portfolio of consumer and industrial products give it broad exposure here. We're taking a look at shares right now. They're holding on to gains going into the open by about 6-7%.
Which is fascinating given that the company said in a statement that tariffs could have a negative impact by as much as 40 cents a share on full year earnings. The caveat on its outlook talking about just the idea of this trade war potentially being a headwind for the company. Perhaps the headwind in terms of the statement today not being as severe as investors thought that it could be, given the fact that this is one of those names, like you were mentioning, Brad, that is very exposed both in terms of goods and imports, but also to the health of the consumer. So if we do continue to see a weaker consumer, this is one of those names that you want to watch in terms of any recessionary impact.
You could scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page.
The Magnificent Seven struggling this year, each of the stocks down more than 23% from their most recent 52-week high amid ongoing tariff uncertainty. This as the mega cap companies begin reporting first quarter earnings. Joining us now, Paul Meeks, Harvest Portfolio Management CIO. Paul, great to speak with you this morning. Talk to me about your expectations for the Mag 7 as we kick off Mag 7 earnings with Tesla today. How disappointed do you think investors might be?
Well, with Tesla, the way I look at this stock is a year or so ago, the stock traded as low as 140. And at that time, its fundamentals were much better than they are today. So even though Tesla is way down, I think it can go lower. I don't think they will have anything positive to say today. And of course, Elon Musk and company will try to dissuade you into thinking they're no longer an EV company, so don't look at their cars, but they're a autonomous taxi company. Believe it when I see it. So I don't expect much from Tesla, but negativity. I haven't owned the stock in a while. As far as the rest of the Mag 7, I've had a very refined list. I'm fairly bullish on Meta and Amazon long term. I'm not playing right now any of the others. And even those two stocks that I favor within the group, I'm a little bit dicey on. So what I would tell people is, even if you're tempted with these stocks down so much from their tops, just wait until they report their results. Wait till you clear that news. People always feel like they need to maybe try to make an aggressive bet heading into earnings. I just think for all these companies, the earnings period, whether they make their quarterly guidance or not, no one is going to be able in this environment to give much confidence with their guidance. And so I'd rather wait to hear that.
You have some of your industry colleagues, such as Wedbush's Dan Ives, calling this a code red moment for Tesla. I wonder what you would like to hear from Elon Musk on the call about how he's governing his time, knowing that everybody can see where he had spent his time in previous quarters, in the last 2 quarters specifically. But now when you have this kind of critical moment for car and vehicle sales that are reaching this impasse that investors are going to want to hear more about how they're going to turn that around, what do you want to hear about how Elon Musk is spending his time on a go-forward basis?
Now, there had been some rumors a couple of weeks ago that he was going to wind down his Doge commitments. Haven't heard any follow-up, particularly from the people that matter, the president and Musk himself. But yes, I would like to see, of course, I'm not positive on the stock at all, I'm negative on the stock. I would like to see him commit to a deadline where he finishes his government duties and moves back to managing his companies.
I want to broaden the conversation out to the tech sector overall, Paul, because we saw some selling of these big tech Mag 7 names prior to President Trump's so-called Liberation Day. How are you able to parse how much of the selling we're seeing in these big tech names is policy uncertainty that's dragging down the major averages, or an unwind of valuations that got a little too close to the sun?
I think some stocks, after big runs, right? So it wasn't just last year, it was multi-year. Their valuations got stretched. But I think what's happened is, in addition to the Trump, induced madness, there are some folks that are wondering, particularly with the latest rumors that Amazon and Microsoft may be dialing back some of their AI data center spend, if that game is up, or have we reached peak AI infrastructure revenues for the companies like NVIDIA that are involved with it. So I think all those factors, but the biggest factor is the economic environment.
And so then at that juncture, what is the timeline that investors should be grading these companies on in order to make sure that they're actually fulfilling all of the fervor that they put forward around the AI thesis within their own business models?
I think what happens is most of the hyperscalers will confirm their AI capex, and so people will feel a little bit better about that. I never thought that at this stage in the game here in 2025 that we would have yet a lot of use cases of AI. And then recently last week, Johnson & Johnson said that it's dialing back its hopes for aggressive AI use. And of course, that was a pillar for AI in healthcare, which is supposed to be a big deal. And so I don't expect much as far as the deployment and the monetization, right? The deployment is one thing. The monetization is another. I never really expected that, with or without Trump, to be much of a focus until 2026.
Paul, I get that your buyer strike continues, but you say that you confidently hold several names: Netflix, NVIDIA, Meta, Broadcom, and AppLovin. Talk to me about NVIDIA specifically. What is your bull case for NVIDIA long term?
So I think NVIDIA never really got to that point that you referenced earlier, where the valuation got stretched, because its run over the last several years has been driven by earnings. Earnings have outpaced its valuation. So now with the stock sub 100, maybe there is some AI pull in from some of the hyperscalers. Obviously, they will be dinged with the tariffs on China, but I still think the demand for their products is voracious and that they will continue to do quite well. Maybe numbers come down a little bit, but right now the stock is trading at a fraction of its PEG ratio, and it should be, even for value investors, pretty attractive here.
Really great point, Paul. Thank you so much, as always, for joining us to break down the Mag 7 trade. And for our audience, want to remind our viewers that you can tune into Yahoo Finance for full coverage of Tesla's first quarter earnings results starting today at 4 p.m. Eastern. When we come back, we're going to bring you the opening bell on Wall Street. Stick around for the market action. And that is your opening bell on Wall Street this Tuesday morning. Look at images live from the New York Stock Exchange and the NASDAQ. Let's get you a sense of where the market action is heading this morning after we continued to see selling on Monday morning. You can now see that stocks are starting to recover just a bit in the morning trade here. You've got your S&P 500 moving to the upside. You've still got a little bit of pressure on some of those tech names. I do want to quickly check on gold, hitting another record high this morning, over $3,500 an ounce here. If you take a look at gold this morning, you can see still moving to the upside as gold continues to be the haven trade amid a little bit of confusion and digestion of whether or not America is the safe haven asset class and asset holder moving forward here. We're going to talk about that a little bit more, but I do want to do a check on some of the sector action as you are seeing the S&P 500 and your tech-heavy NASDAQ moving to the upside this morning. All eyes will be on Tesla later today. Earnings coming out here, the first of the Mag 7 to report. You can see the Mag 7 firmly in the green this morning. Broadcom under just a little bit of pressure here, but a welcome reprieve for some of these big tech names as they've continued to see a lot of selling, especially over the course of Monday's trade. Brad?
The so-called Sell America trade is top of mind for investors navigating uncertainty from trade to the Federal Reserve. Here to track where the trade stands, we've got our own Alexandra Canal. Hey, Ali.
Hey, Brad, that's right. Risk-off investments like the U.S. dollar and long-term bonds, typically viewed as historical hedges against volatility, they aggressively sold off on Monday. We saw the 10-year yield surge back above 4.4%, while the U.S. dollar dropped to its lowest level since 2022. Early trading on Tuesday saw a bit of a reprieve, but not much. The yield on the 10-year continued to trade around 4.4%, while the U.S. dollar index also wavered below the critical 100 level. That's a key psychological and technical milestone. Now, these types of moves are pretty unusual. Instead of flocking to safe havens like U.S. bonds or currencies, investors appear to be pulling back. That's something Wall Street strategists have described as the Sell America trade. And we've seen this shift in sentiment really accelerate as traders make strong moves into commodities like gold. The precious metal rallied to yet another record on Tuesday, a clear signal that investors are seeking non-dollar denominated, globally accepted stores of value. Now, the exact catalyst for all of this, it remains unclear as investors continue to react to a U.S. economy already under pressure from tariffs, slowing growth, and escalating geopolitical tensions. We also now have the added risk of a potential political interference in monetary policy. That seems to have been one of the main drivers when it comes to Monday's sell-off, but it's not a good spot to be when the U.S. trade loses its luster. According to J.P. Morgan, U.S. equity ETFs saw net outflows of $3.6 billion last week, while developed international markets attracted above average inflows totaling around $3 billion. And that is a notable shift considering how heavily U.S. markets rely on foreign capital. If we look ahead, we have heard from some experts that say the long-term prospect of safe havens remains intact, but in the short run, it's likely we will continue to see this volatility until we get some firmer updates on U.S. trade deals and also see an improvement on the fundamental side as earnings continue to trickle in as well. And we have Tesla coming up after the bell this evening. That's going to be the next big catalyst to watch there. Maddie, Brad.
All right, Ali, thank you so much. Appreciate it. It's time now for today's strategy session. U.S. stocks rising this morning despite the Sell America trade gaining traction on Wall Street. So is now the time to buy into U.S. stocks. Joining us now, Ken Mahoney, Mahoney Asset Management CEO. The big question for me this morning to you, Ken, do you buy the dip or do you sell the rally?
Sell the rally. I mean, we have so many things coming out. Just the report, that 2 minutes there of everything that's going on in the world. Like, we want to be heroes. This reminds us of 2022, not the political side of it, but, raising rates 75 basis points, 75 basis points. And our goal is to get through the other side of it unscathed as much as possible. So we're actually saying sell into rallies. Again, like we had the 2,968 point Dow Jones rally, sell into it, try to wait for a better setup. Right now, there's way too many forces upon us. I mean, we have Hurricane Donald that, it could tweet just moments from now and watch everything come undone again. And the problem really is, this finger pointing with the president. And yesterday, we saw with Powell. Look, we have not been the biggest supporters of Powell back in 2018, talking about, increasing rates, only do emergency rate cut, transitory. That didn't work out so well. But here, it's actually Donald Trump is the one with, spill in aisle 6, spill in aisle 9, spill in aisle 9. Oh, here, Powell, clean this thing up. And it doesn't work like that. So really, the president really needs, in short order, to get a deal. We keep on hearing like, oh, we're close to a deal, we're close to a deal. It's like a used car salesman telling his boss, like, oh, I almost got him. I almost got them. He needs to get a deal done. Otherwise, this is going to continue to unravel. So the short answer to your question, we would sell into rallies. By the way, some of the biggest rallies you'll have, the biggest rip your face off rallies, are in bear markets, which we're in.
It also raises the question, which deal? I mean, we're talking about multiple countries that still have tariffs, and China, of course, having the large and lion's share portion of those tariffs, the second largest economy in the world and one of our largest trading partners. So all of that considered, which deal is the market actually going to look to say, okay, this starts to set some precedent for us to see how the negotiations are going to go forward elsewhere? Oh, yeah. And by the way, other countries are going to catch wind of the deals that are being made for some of the other counterparts that are waiting for tariffs to come off the table.
Yeah, there's a lot to untangle there, but I would start off obviously with Japan. And look, this is done incorrectly to start with, right? There's a big Canada approach, and that little list that he showed everybody, we were thinking like rational, maybe 10% tariffs and kind of work from there, but instead 47%, 104%. It's just like, you might as well just, ban imports from China. I'd like to see a deal for Japan. I'm not sure that can happen or not, because at least that kind of solidifies Asia. The way to do this, though, obviously in hindsight, but it should have been thought about, is kind of moving up. The lowest hanging fruit would be, let's say, Argentina or Mexico or maybe one of our trading partners, and then eventually get to China. But instead, this big blast has really put us in a big way. So all the things that investors are feeling right now, unfortunately, they shouldn't really feel like this. But hey, 72% of Americans that voted for Trump own stock directly or indirectly, and they feel like just get passed along, especially Treasury Secretary's comments, Treasury Secretary comments like, oh, don't worry about it. You have to have some pain and so forth. They're furious. They really feel they got stabbed in the back. They did not ask for a world trade war out of this Trump administration 2.0. They wish they had Trump 1.0 is what I'm hearing.
Well, that's interesting, because I'm also hearing a little bit of a different narrative from the politician side of things. But having said that, I want to talk about at what point you turn more long-term bearish on the U.S. specifically. At what point do you start to say, okay, we really have to get out?
Well, it'd be earnings. Right now we're looking at probably economic recession and earnings recession. And again, we've seen, by the way, this morning, I thought it was pretty good. General Electric, 3M, you noted here. I was kind of surprised, but maybe, it's this kind of thing when you come limping into earnings and the bar is so low, that's probably a better spot to be with earnings. But the visibility, I don't know how they're going to do it. I know UAL, United Airlines, last week broke it out two different ways, the earnings expectation, their guidance. Well, if we have tariffs, it's going to be this, we have this, that. So again, it's really difficult, especially a lot of companies tell me they finally got over cleaning up these supply chains, right? 2020 with COVID messed up all supply chains. And here, self-inflicted, that's the hardest part I hear from business owners time and time again, is that the vendors are now hoarding things, suppliers are hoarding things because prices are going up. And the unintended consequences of this is more severe. And there are things that other dominoes are going to fall that we're not even thinking of. I don't think we came into this year on a bingo card thinking that a pro-business administration and less regulation would turn into this zoo that we have here. But then again, he surrounded himself with people that are really tariff hawks, and here we are.
And nobody in the checks and balances that Henrietta Treyz was bringing up with us earlier, nobody seemingly kind of pulling in the reins as well. And so I guess with that setup in mind, if you did see, because of the kind of self-induced juncture we found ourselves in, Does that also mean that on the backside of this, if all of a sudden there are deals that start flowing through that allows the president to say, see, I did it again, is that enough? Is relief enough for it to kind of lead to a conviction trade that everyone would say, all right, rally's back on?
It's hard because, I try to always separate the personality of Trump and the policies, but they're one and the same, right? The way bombastic he goes against our allies makes it very difficult to get behind it. So maybe put a Band-Aid on it like we did with Paul's 90 days and you get those one-day rallies. Those will be sold into. Again, I think a better setup down the road when the VIX settles down at 30-something. That implies like 2.5% intraday movement. Good for traders, not good for investors. We'd like to see higher highs. I mean, we're so far off of actually putting any meaningful dollars to work. We'd have to see, again, I know buyers live higher, so to speak, but you'd have to start seeing the trends go higher, above the 200-day moving average, volatility decrease, and we're not seeing any of that. As you mentioned also, too, about gold and all the dollar being devalued. This is a real mess. And when we call it Hurricane Donald, the only question is this a hurricane category 2 or is this a hurricane category 5? And it's starting to look like a 5. I mean, just, run for the hills, evacuate type of thing, unless somehow they can get some deals very quickly. This can't last for weeks or months. He's got to really try to find a deal, and it's on him. It's not on Powell, obviously.
I knew I should have used my parents' Costco membership to get some gold bars. Ken, thanks so much.
Those hot dogs, too.
Well, of course, you gotta load up on those. Thanks so much, Ken. Good to see you.
Thank you. Bye-bye.
A stock we're watching at the market open, Boeing, announcing a $10 billion deal this morning. The company agreeing to sell portions of its digital aviation solutions business to private equity firm Thoma Bravo for nearly $11 billion. The CEO, Kelly Ortberg, saying the deal is an important component of its strategy to focus on its core businesses and supplement its balance sheet to prioritize an investment-grade credit rating. The deal comes ahead of Boeing's earnings results this week. Shares are moving higher during today's session.
Shares of home builder Pulte Group up over 5% this morning after the company reported a first quarter earnings beat and slightly lower than expected home sales revenue of $3.7 billion. While average home prices rose 6% to an average of $570,000, total homes sold fell 7% from the same time a year ago. Pulte Group crediting affordability challenges for home buyers as one of the reasons behind the decline. Here with more on the housing market and home builders, we've got Alex Barron. He's the Housing Research Center president. Alex, great to speak with you. I want to zero in on that affordability challenge that we heard about from Pulte, and that, of course, comes before any impact of tariffs. Where do you see affordability heading for home buyers over the course of the next year?
Well, affordability has been challenged, ever since the pandemic. First, because home prices rose significantly when interest rates were low, and then when interest rates went up, 2022 to 2024. That was kind of the thing that really hurt most consumers. I'd say close to 80% of American households can no longer afford to buy even the cheapest entry-level home. Where it goes from here is going to be dependent on where interest rates go. So if the Fed starts to cut interest rates, that will help. If they don't, then I think affordability will remain challenged. Most of the builders have guided to maintaining incentives really high. So obviously they don't think any help is on the way.
And so how does that impact some of the backlogs? Because we know for some of the new home builders, they're just trying to make sure that as they're increasing supply, it's at a level that it's still profitable for them, but also one that is not leading to further market deterioration. And that has been a larger issue in the affordability crisis that we've seen play out.
Well, most of the builders were getting gross margins of close to 30% about 3 years ago. And if you were to back away most of the incentives they're currently offering, to some degree, they're still close to that level of profitability. But longer term, gross margins have always been in the 18 to 22% range, which is kind of where they're drifting to right now. And yet many builders are still significantly above, like Pulte, I believe, is at 27, 26% range. So there's still room for the builders to make plenty of money, even if they have to adjust pricing or offer higher incentives, they're still making plenty of money.
Something that's, of course, of concern to home builders, home buyers, is the status of the 10-year yield, which is, of course, tied to mortgage rates. This administration wants a low 10-year yield regardless of any sort of policy outcomes outside of that. From where you sit, is a low 10-year worth it, regardless of any other economic pain that these policies might cause?
Absolutely. Home building and home ownership, I believe, is the bedrock of American prosperity. And for homeowners,
even if it pushes us into a recession, Alex, it's worth it to have a low 10-year?
Well, I don't see how it's going to push us into a recession. Usually low interest rates drive investments, and certainly it's going to drive activity in the housing market, which is one of the biggest drivers, of economic activity. So I'm all for low interest rates, and I believe, obviously, most homeowners probably would be too, because they'd love to buy a home. I believe there's lots of pent up.
They can buy one in a recession, yeah. Go ahead, Brad, sorry.
I mean, I guess the other additive here, Alex, is of course, if we do have lower interest rates, then that's typically in response to a deteriorating economic condition, which would then suggest that it is more difficult, not just for people to get approved to buy a home, but also the capital that would be required, that it's largely seen because of previous instances in historical data that the home buying could sputter or decline significantly at that juncture. So what would the home builders then need to do in that instance if they're already giving buy downs, if they're already giving concessions, and then you have a broader collapse of the home buyer sentiment?
Well, that's not necessarily how it works out. If you look at the last recession that was pretty long, from 2000 to 2002, the home builders were growing through those years and were making plenty of money. So it's not necessarily true that because we're in a recession that less people are going to buy a home. If the mathematics works in terms of a payment, that will drive people to buy a home. And that's what low interest rates would do, which is why I believe the Fed needs to cut right now. And I believe that will drive home ownership to very strong levels. Right now, the housing market is not weak and it's also not strong. It's kind of in the middle. But I believe we should be, due to fundamental demographics, we should be doing close to 1 million new home sales, not around 600,000.
Yeah, I guess the thing, though, that we did jump over in going from 2000 to 2002 is clearly the great financial crisis, where home buying did become significantly more difficult between 2007 to 2009, and because of a combination of factors. So there's a lot to continue to discuss with this. Alex, we got to leave it there for today. Thank you for joining us.
Thank you.
We've got all your markets action ahead. Stay tuned. You're watching Morning Brief. Investors are closely watching a slew of Fed officials speaking today. Wall Street watching for any commentary on the central bank's next move amid the rising political tensions with the White House. Yahoo Finance Fed correspondent Jennifer Schonberger, not too far from 1600 Pennsylvania Ave herself, and has the details. Hey, Jen.
Good morning, Brad. That's right. Markets listening in very closely to Fed speak as President Trump has laid into Fed Chair Powell over his recent comments and threatened to fire the Fed chair before his term ends in May 2026. Today and this morning already, we've heard from Vice Chair Philip Jefferson, along with outgoing Philly Fed President Patrick Harker, both speaking on economic mobility. This afternoon, we'll hear from Minneapolis Fed President Neil Kashkari, along with Fed Governor Adriana Kugler, as well as Richmond Fed President Tom Barkin. Tomorrow, we also have a number of speakers on deck, including Chicago Fed's Austin Goolsbee, as well as Fed Governor Waller. And of course, markets looking for any signs of stability amidst all of the volatility that we are seeing with global trade and expectations as it relates to inflation, growth, and what the central bank will do with interest rates. This is the last week we will hear from Fed speakers before their blackout period ahead of their policy meeting on May 7th, where policymakers are widely expected to hold rates steady.
And Jennifer, the IMF releasing their global economic outlook this morning. They see the ongoing trade war as a drag on both global and United States growth. What else are they saying?
That's right, Maddie. The International Monetary Fund is predicting that tariffs and uncertainty will lead to a significant slowdown in global growth this year as President Trump tries to reshape global trade through tariffs. In their brand new World Economic Outlook this morning, they're estimating this year that half a percentage point will be shaved off of economic growth, falling to 2.8% from a prior estimate of 3.3% before recovering to 3% in 2026. Global trade growth is forecast to be cut by more than half, slowing to 1.7%. And the chances of a global recession have now risen to 30%, up from just 17%. The international body called Trump's April 2nd reciprocal tariff announcement, quote, a major negative shock, noting that the global economy is at a critical juncture. And while President Trump has paused reciprocal tariffs for 90 days, the IMF is warning that ratcheting up a trade war along with even more elevated trade policy uncertainty could further reduce near and long-term growth. It is the uncertainty that's really driving the downward expectation for growth. Now, when it comes to the U.S., the IMF expects growth to drop nearly a full percentage point this year to 1.8%, while inflation is projected to rise by a full percentage point. The IMF now pegging chances for a recession here at 40%, up from just 25% odds back in October. And Maddie, the outlook for growth for China has also soured. The IMF seeing that now clocking in at 4% this year, down from 4.6% originally. Back to you.
All right, Jennifer, thank you so much. Appreciate it. That's going to do it for the morning brief this morning. You can join me in the next hour for more analysis on Catalyst, and then you can join Brad for Wealth after that. Stick around for more.